place. And that one has turned decisively ugly over the last couple of weeks.
Okay, so when I look at UBS just comes out and puts, I guess this is the word we're going to be using today. UBS comes out and, Rob, if you want to pull this up, puts U.S. recession odds at 93%.
Damn.
Is what they said. Not 50%, not 40%, 93%. Some may even ask, if you were to take the Max 7 out, are we in a recession but nobody knows it?
That's market breadth, right?
Right, so UBS currently assigns a 93% probability of U.S. recession based on its analysis on hard data such as employment, industrial production, and income and consumption.
Well, you look at the macroeconomic statistics heading into the summer, before the government shut down. You look at the labor report. There's a negative payroll number on the board for June. So we were already job shedding, and that's been confirmed by ADP and a number of other surveys, including the Federal Reserve's own surveys. We talked about this earlier. Consumer sentiment has been decisively negative all year because consumers realize there are no jobs. So the situation on mainstream is far more dire than people who are only focused on the stock market are really getting a sense of.
Tom.
So I'm about to get slaughtered on both sides. On one side, you hear me talk about the market. The market is managing itself to the benefit of the shareholders. That's what the market is doing. So as you said, Wall Street is its own world. It's a very big world. And by the way, Mag 7, they talk about Mag 7. Mag 7 is bigger than all of the European stock markets. All. ALL. So Mag 7 is bigger than the entire continent of Europe on an investment basis. So it is a
huge red flag. That's a bright flag.
They should have their own flag, their own blue flag with 7 stars on it, and be like, we got your EU right here.
500. Wow.
Yep. And so now then, so they are managing to manage profits, which includes layoffs, which includes active use of AI and a lot of things like that, because they're trying to manage profits. That's the stock market. I'm going to call it right here. I have felt for the last 2 months that we should be using the phrase labor recession, because I believe we are in a labor recession. And I think that there are numbers that the government under Biden they haven't fully, fixed the way they were doing. Let me say why, Pat. If you overstate actual labor, because they use average incomes and a percent of income for tax and then a percent of income for spending, you're overstating GDP estimates. Make sense? Oh, you didn't have that many people working. So you can't take 20%. I think that's 17%. Take 17% out for taxes, and the rest is what they spend in the economy on this, that, and the other. And they overspend. Here's some facts going on right now. Credit cards have hit 1.25 trillion. We're back into that territory again. So number one. Number two, car repos are going to be the highest this year since, you ready for this number, Pat? 2009. Car repos this year will be highest since 2009. It's almost there right now, and all it has to have is a little bit of trend in November, December, and it beats 2009. The fastest growing delinquency, by the way, people like Cox Automotive, they cover repos. They like to say, oh, no, you're just talking about subprime. Subprime borrowers got into trouble because interest rates were so high, and they had 9 and 10 and 11% loans. No. Would you like to know right now, today, going into fourth quarter, the fastest growth in delinquencies in car loans is prime borrowers, not super prime, prime.
And prime that were aged between 30 and 39, so prime working age borrowers.
Correct. That's exactly right. Thank you very much.
Huge red flag.
We're on that. Also, what you have, that's just that. You now also have people talking about mortgage delinquencies. And by the way, Rob, you pull this up, the chart I sent you, it's the one on the refi denials. Yeah. Look what is happening to mortgage refi denials. It's not that one. It's the other one I sent you. I sent you just
These are the two that were sent.
No. Down in my email, there's a couple of them. The mortgage charts, denials are up in red. Yep. So
Tom, while he's looking for this, I just looked this up. So and I'm going to bring you back to you, because with Max 7, S&P is up 15 to 16% year to date. Without it, it's still up 12 or 13%.
That's correct. They're successfully managing it. Consumers.
How much of it is Max 7 driving everybody else? So if Max 7 clients, everybody else follows.
Yeah, and by the way,
it gives you protection. If you have the Mag 7 stocks that are rising, then you can buy everything else and justify it as the market is going higher.
Yeah, and is this the go to refinance? The next one down on the left column, right there. Go take a look at that, Pat.
Holy moly.
This is the denials and refis. These are all the people that coming out of COVID.
God.
Remember when they came out of COVID and some people got 7.5s and 7 3/4 and some 8s? Remember that?
Yeah.
Well, guess what's happened? The rates now have down to 6 1/4, 6 1/8, or pay a point and get 5 and 7/8. But they're getting denied by the bank. Why? Because you're late on your car loan and your credit card is 1.25 trillion. That's what's happening right now.
This is, if you look at this here, the blue is application rate, which is the lowest it's been in 10 years. The last 24 months, the higher one, just first quarter 2024.
That's higher interest rates. Some of that is due to higher interest rates.
Okay, which is fine. Which is fine, because we see the decline coming from Q2 of 2021 when they started increasing rates, and that just kind of came down, right? And in the last 12 and a half, 18 months, it's been flat. But for rejection to be at 45.7,
all-time high since they've been measuring it.
That's the banking sector.
All-time high since they've been measuring it.
Are you kidding me?
I'm not kidding.
That's the banking sector saying
when did
the
they start
economy
measuring
sucks.
it, though? When did they start measuring it, though?
2010, 2012.
For that statistic, I think goes back to 2003.
Well, that's a good, ample enough of a inventory of data. There's enough events that's happened since then. So you said something while I interrupted you. I was speaking. Both of us were speaking at the same time. I want to make sure the audience hears what you said. That is the way of banks saying what?
The economy sucks. That's banks saying we have all of the fundamental information when somebody fills out a credit application. We've got their jobs, we've got their income, we've got their credit score,
underwriting,
when they actually do it.
Well, then let me get into.
So the banks are saying, I have your information here, and the stuff on here doesn't qualify.
Can we add one more thing to put in perspective? Meta 2 weeks ago had 11% decline. Remember the stock, Facebook, Meta had a big decline. A week later, they sold to the street $25 billion in bonds. How many times oversubscribed was it? Because you know when they say oversubscribed, more people want it than can get it.
Not many?
5x.
Yeah.
There was $125 billion at the door, trying to get in
Because they want to put the money to work.
and because they're going to get a fixed interest rate from Facebook. Facebook's got to sell the bond at a rate. So what they're saying is they trust more of the bond right now than they trust the actual stock price.
That's why. That number is why. Because
So it drops 11%, but Facebook is able to sell.
Okay, but let me get to this.
So
I don't want to confuse the two. I want to stay here.
But it's all the same
I
money.
understand it, but we're talking about mortgage application specifically. So I want to get to the story here because this was a topic yesterday also when we were at the Goldman Sachs meeting when they asked the Vice Chair Rob Kaplan on what the thoughts are on 50-year mortgages as well as this portable mortgages. So Trump is considering portable